Exchange-traded funds, or ETFs, and mutual funds are two popular ways to invest your money. They both pool money from many investors to buy a mix of stocks, bonds, or other assets, but they have some key differences that might make one better for you than the other. Let's break it down in simple terms. First, how are ETFs and mutual funds similar? Both are like a basket of investments. Imagine you're at a market, and instead of buying individual fruits, like apples or oranges, you buy a basket that has a little bit of everything. That's what ETFs and mutual funds do. They let you invest in a variety of assets at once, making it easier to diversify and lower your risk. Now, the big difference is how you buy and sell them. ETFs trade on the stock market, just like individual stocks. You can buy or sell them anytime during the trading day, and their prices fluctuate throughout the day based on supply and demand. Mutual funds, on the other hand, don't trade like stocks. You buy or sell them directly from the fund company at the end of the trading day, and their price, called the net asset value, is calculated after the market closes. Let's look at an example. Say you're interested in investing in the technology sector. If you choose an ETF, you can buy shares of a tech ETF on the stock market at 10 a.m., see the exact price you'll pay, and even sell it later that same day if you want. With a mutual fund, you place an order during the day, but you won't know the exact price until after the market closes. Another difference is cost. ETFs are often cheaper than mutual funds because they're usually passively managed, meaning they track an index, like the S&P 500, without frequent buying and selling. Mutual funds, especially actively managed ones, tend to have higher fees because professional managers are picking and choosing investments for the fund. Over time, these fees can add up and eat into your returns. Let's talk about flexibility. ETFs give you more control because you can trade them whenever the market is open. They're great if you want to react quickly to market changes or take advantage of intraday price movements. Mutual funds are less flexible since you can only trade them at the end of the day. But for long-term investors who don't need to trade often, this might not be a big deal. What about minimum investments? Mutual funds often require a higher minimum amount to get started, sometimes $1,000 or more. ETFs, on the other hand, don't have minimums. You can buy as little as one share, which makes them more accessible for beginners. So, which one should you choose? It depends on your goals. If you like the idea of actively trading and want lower fees, ETFs might be the way to go. They're also a good fit if you're starting with a smaller amount of money. On the other hand, if you're focused on long-term investing and prefer a hands-off approach, a mutual fund, especially one with active management, could be a better choice.